Good morning. Welcome to the state of the market. How you doing? I'm going to do about 2 minutes on the state of the market for all of you that all of you that were here yesterday. Guess what I'm doing today? Weekly profit cycles. I'm sitting on my calls, hopefully for the next 2 days, 3 days, and see if we get a little bit of a run. Closing like crazy this AM. All of your longs, Mike of Albion, all your overnights, you're like, close, I got to get out of everything. So here's something to keep. So today, let's see how these indicators set up for you. At the end of class, we'll see if we have something looking, good. And see if we get a little beat on the market after we talk about 9-day Vix today. This will be about 30 minutes. And by the end of class, hopefully you have something useful. But I want to give you let's just call it a simple way to look at volatility and why the 9-day indicator is important. Let's see, we got live vol right now. We'll just do a little market update. And I'll tell you what, okay? Here's where we were at the beginning of the week. I'm just looking at VIX before we get to the 9-day. Here we are at the beginning of the week, the last 10 days. Okay, today's Thursday, Wednesday, Tuesday, Monday low, Friday low. Right, like 20. So you want us to start going down there. We got a little English trade deal possibly. You get a little VIX softening up here. Kind of breaking through the lows of the week. Then I like us to go higher. I like that FOMC trend to continue. Basically, the Fed didn't give anybody anything yesterday. So from a state of the market point of view, like it looks good to us. Why lower rates? And that's what we got. So what I want to do today is understanding the importance of the VIX 9-day indicator, how it will help your trading, how it will improve your trades, or how you improve looking at the market. So the first thing I want to do is get you a little understanding of why does a 9-day option actually matter? So we're looking at the SPY. So just ignore these little ramblings here. All right. So what I want you to do is walk with me down a 9-day option versus, so we go 9 days, right around here. Let's just look at the money here for a minute. Just going to look at the money, and we're going to say, hey, okay, let's look at that 565 call. Boop. And now we're going to look at a 30-day option. So right around June 6th, and we're going to look at the same 565 call. Now, the big thing I want you to get from this is the difference between how a 9-day option decays at $463 and then how a 30-day option decays at $250. So do you guys see the difference between your 9-day option decaying at $460 and your 30-day option decaying about half as much? So the reason and reality of the situation is 9-day options, which when I was a floor trader not many years ago, but I'm going to say it's getting on 19 now, 18, 19 years ago. Probably the floor was done by 2013, 2014, I think was really pretty much, there's open outcry now, just VIX and SPX, but I'm going to say broad open outcry was starting to go away about 2010, 2011. But the idea of a 9 or 10-day option, so this is decaying, a 10 lot is decaying at $400 a day. So if you spent $600, $6 on your option, $6,700 on a 10 lot, like your options are decaying at around 8% a day. If you're going to trade an option this close to expiration, if you're going to buy them, you have to be very right because they're decaying so rapidly. A 30-day option is going to decay roughly half as much. Whoops, got to click it right here. There we go, at $250 a day. So you're spending $1,300 on your calls, but the decay is a fraction of what your 9-day volatility or your 9-day option is going to be. So the sentiment for either contract is you have to be bullish for each call you buy. But you have, because the decay is so fierce relative to how the option is priced on a 9-day option versus a 30-day option, you have to be very right on direction. So traders moving and getting into 9-day options generally do so with a lot of conviction. If they're buying 9-day options, it's with a lot of conviction. So the reason why looking at a 9-day VIX, which is essentially taking your SPY options and looking at the 9-day volatility versus regular VIX, which is 30-day volatility, is you want to see get a gauge of how sensitive traders are to that very short end of the curve. Because basically you're buying something that's melting like right away. It's starting to melt right away. However, right, if volatility goes up a little bit, so I want you to see the difference here, theta and vega with a 9-day option. Volatility moves up 1 point. What that means is if I buy these calls and volatility moves up 1 point, that 1 point of vega, so every time volatility goes up 1 point and I'm long 338 vegas, that means it's going to cover roughly 75% of my decay for the day. So a 1 point move up in volatility is going to change the value of my option. So when I go to Thinkorswim and I just go, hey, I'm going to move the volatility up 1 point and go bing. Okay. Oops, I could learn to use the system, Andrew. Every time I put $1 in there, it won't let me. There we go. And instantly, boom, right? With volatility lifting, the value of my options goes up. Also notice that your theta goes up as well. So as volatility goes up, your option prices increase in value, but your theoretical decay also is going to go up and up and up. So as volatility continues to increase, watch the theta number here. Now I'm over $500 a day in decay. But you as an option trader, if volatility is rising, you don't care. Why don't you care? Because every time volatility goes up, your options increase in value. I just made $650. I didn't do anything. Market just sit here 2 ticks, hasn't done anything, but my position has made money. Now, if I take this back to why is 9-day VIX, right? 9-day VIX is measuring this changing number. So traders, when 9-day VIX is rising, that is the market basically saying, hey, volatility in this short term is now going up fast enough that it is outpacing the decay in the options. So there has to be, the market sentiment is like, hey, we are moving, because it's much more sensitive than the 30-day option. That's why it's a good indicator, right? So if that 9-day volatility is going up, all of a sudden everybody realizes, or if you're trading, right, they're traders, right, liquidity providers, don't forget, if they're buying these options, they know what the decay rate of the option is. So as volatility rises and rises, what they're doing is they're willing to pay up for options that are decaying faster. And the reason they wanted to pay up for options that are decaying faster is because they think the market is moving more. Now, let's take this and break it down to kind of just a couple of simple indicators, right? So the first thing is, okay, and I will give everybody a copy of this at the end of the day, and I'll scroll back and answer questions at the end. So first day, what is the 9-day VIX in general? Why do I like it? We'll get into that. But what I wanted to lay out for you is if you have short-term options and you have an indicator that's moving, it's very sensitive. You're like, okay, what does the market think? So today, what does it think? Okay, we were up probably almost 1% pre-open. VIX was up, and all of a sudden things are kind of like getting sad. The trend we had this morning hasn't exactly developed, right? Market is kind of wishy on it, I would say right now. What's the 9-day doing? Well, I have to say it's up on the day. So after spending yesterday, again, watching how the Fed acted, right? Everybody was a little worried. The market went a little south, spiked. And then since then, we flattened out this morning and we've been slowly been creeping up. Now we'll take a look at this at 10:30 at the end of class. But right now, I never think the 9-day volatility going up on a Thursday into a weekend is a great indicator. Actually, it's a good indicator, but it's not a bullish SPY indicator. If anything, it's leaning slightly bearish. Now, normally after an FOMC move, like I said yesterday, we have that 5 days following the move, you get a pretty good move. We've already had a 1% move this morning, and we've already pulled back almost to unchanged on the day. So in reality, we've had like a 2% range in SPY or near 2% range in SPY already. But you don't want to see this number continuing to go up here, or I think our tone of the market is going to change from slightly bullish to bearish. And that's what we got so far. We almost kind of hit those lows of Monday, but that's really what you want to see. If you see this starting to drift lower today and get back to that sort of Monday level, I think that will be very bullish overall for SPY, and that could push us to 570 SPY and higher. But as of right now, again, I think we're just a little wishy, waiting for some news, some confirmation on some trade information. Okay, so the next part is, so the 9-day VIX calculation, what is it? It's basically the VIX calculation on options centered around 9 days. So the idea is, instead of using the 30-day VIX calculation, it's going to use options right around 9 days, but everything with a bid. So again, your 9-day VIX is also giving you the at-the-money volatility for the SPX, right? 9-day option. Now, this option doesn't exist. It is an index that is basically kind of, it exists only that the SIBO prints the index out, but you really can't trade it. You can follow it. So right now, that market indicator is saying that volatility right now is 23% 9 days out. So the market is telling you it expects, right? So at 23.34, it's very close to 24. It expects And I'll write this a little bigger for everybody. It expects near 1.5% per day in SPY, SPX. Again, SPX just 10 times SPY. So now every 16 points in the 9-day VIX is 1% in SPY. So if we're trading at around very close to a 24, 24 is roughly 1.5, right? So every 24 points is 1.5%, and then every 32 points is 2%. All right. So if you want to, now the market already, if we're up almost 1% and then we're back down to 0.25%, we've already moved 1.5% on the day. So you could take a look at this and say, is 23 or near 24% for the index, is that an accurate reflection of what the at-the-money volatility should be 9 days out? And I would say probably, yeah, because we're moving. We're moving up, we're moving down. So how I use this indicator is, again, how much, since you have an idea of how much we expect, right? We haven't even gotten like 1.5% in either direction, either up or down. So if you're putting on trades, you have an idea how much the market is going to move just by looking at the indicator. So right now we're trading at a 22.93, so it's pulling back just slightly. But that's still almost 1.5%. So if you're buying calls, is it unreasonable to expect the market to be up near 1.5% in 1 to 2 days? No, it's not. Is it unreasonable to expect the market will be down 1.5% in 1 to 2 days? No. Now, what I want you to do next is look at how the market is comparing a 9-day number, 22.85, to a 30-day number, 23.13. That's the next part. So what I have here on the sheet is, on our handout, is just basically giving you an idea of how the 9-day VIX can move. Like this is like, boom, this is when things were going nuts here in December, a 1-day spike, insanely high, right? And then look at how fast it goes back down to earth. Now, wouldn't it be nice if there was a future or something like this that you could trade on the 9-day? There really isn't. What I use it really for is an indicator on how I think the market is going to move, and we'll talk about that in a few seconds. But what it's giving you an idea is market correlation between 9-day VIX and SPY is very strong, meaning, if 9-day VIX explodes, SPY generally is going down. If 9-day VIX starts to relax somewhat, like to see all these little slow melts down, generally very bullish SPY, right? Those are very longer trends that tend to work very well. So as you look at this, getting an idea of how we're moving, the next part is finding here. I have a little note here for you. This is important because 9-day reacts to intraday moves, while 10-day realized vol looks at the backward moves. So right now we're kind of in an odd place in the market, and I'll show you why. Right. So if I look at SPY, the last 10 days, and I'm going to pull up a chart for you here. Okay. The last 10 days, the volatility has dropped in SPY close to close to around a little under 14%. So with 9-day VIX at a 23, the close-to-close volatilities have been on a long, slow descent. But VIX and 9-day volatility has not gotten down there yet. The market is not ready yet to let it go. Traders still will pay up for that volatility. So I would say there is, because you have this huge premium to how the close-to-close volatility is trading and how VIX is pricing, the market's not ready yet for what I would call that sort of, long-term bullish move with the total vol collapse. You still need this number to go down. Now, as I move here, so this is a chart here relative where you have, this is your 3-month chart of 10-day volatility. And up here you have SPY candles. So again, market rallying, volatility going down here. Again, volatility starts to collapse. It gets softer, right? Now all of a sudden market starts to rise a little bit. This is a choppy market up, and then realized volatility tends to go down. So again, these are very strong correlations between, stocks going up and realized volatility slowly going down. But right now what's happening is traders, those traders are not paying up for they're still paying up for options in the short term because they think, or other traders are paying up for options going up. All right. Now, as far as trading a 9-day VIX goes, how do you go about doing it, or how do you go about using it? And my answer to you is you use it relative to another indicator. So my favorite one to use it in is VIX. So as long as, let's go to 9-day here. As long as this number, VIX 9-day here, continues to drop or stay low relative to VIX, I want to lean a little long. So today, actually, this is probably one of the first days of the week that this number is starting to relax a little bit. Generally, you can't have a longer term drop in vol until short-term volatility, 9-day volatility, drops below the VIX. So today, if you're expecting, is our rally going to pick up and have legs? You want this number here to start plummeting below VIX, right? You want to lean a little long into that. So this morning there was a little bit of agitation, and then we'll see if we get like a clear signal if 9-day volatility starts dropping rapidly below VIX. So here, a couple of general trends. If 9-day VIX is going down, SPY should be going up. If 9-day VIX is going up, in general, SPY should be going down. A couple other things to note. You should see this again. If SPY is rallying, the 9-day VIX should be declining. If it's not, I don't think the rally is going to last in SPY. If I lead with the VIX drop, meaning VIX drops sharply, your VIX 9-day should rise. That is what you expect. So again, a trick is if SPY goes up and the 9-day VIX does not decline, even stays flat, I don't expect the rally to last, or I'm going to set up with a kind of a short lean strangle or something like that against a position. Now, here's a couple of things. And sort of what my last thing before I start answering some questions here at the end. If your VIX is below 9-day, you expect SPX to move more. So as long as your 9-day volatility is less than the 30-day, remember that's that highly decaying option, SPX movement should start contracting. The candle should be getting smaller. So today it looks like probably the first day of the week. Maybe we get sort of a little bit more gentle of a rally if this starts to build into the end of the day. If your VIX is above the 9-day, meaning VIX is a little bit higher than the 9-day volatility, right? You're going to expect SPX to move less. So if VIX is less than your 9-day vol, 9-day basically, traders are paying up for short-term options. SPX is going to move more. If VIX is above 9-day, then you expect SPX to move less. And that to me is the easiest way you can actually trade the index. Or you set up volatility positions like with the vol products, or how you want to maybe lean a strangle and SPY, or if it's worth, like an overnight trader into the end of the day, if you have any strength, you see that 9-day volatility diving 2-3 o'clock in the afternoon, there could be some more legs to an SPY or an SPX rally by the end of the day. So it's a nice little indicator to look at to build a move into the end of the day. I will have this sheet available, I think, when Christian sends everything out. Now, some questions. Is this superb? Yeah, I'm going to send the ebook out to everybody. How do market makers jack up the IV? Easy. They just do this. They hit a button, Enzo. They just hit a button. They're like, I want volatility to go higher. Right? That's what I did for 16 years. That's what Leisha did for 15, 20 years. Okay. Mark, 10 years. Hans on the TSE. I think at some point, Jose, we'll move this into 0 DTE, or I'll just do a 0 DTE around this, I think. So we will be posting this document for you and sending it out. So again, it's just a little reminder on why 9-day volatility can be important for your trading. Also around market turnarounds. Is there a way to get a WA? You always got to ask one of those questions. Is there a way to get a 5-day VIX? The easiest thing you could do, WA, is look at the sigma volatility for 5 days. So if you want a 5-day VIX, but you have to compare it to apples, meaning if I go to SPY, I look at the options, and I get, what a 5-day number here is. Let me see. That's 2062. But again, you have to compare it with the other sigma volatilities that come behind it. So you have to, one thing about volatility in general is you have to compare apples to apples. Apples to apples. So this extrapolates to indices generally. So Andrew, I would say it extrapolates actually to all products, as long as you have so a volatility like a sigma vol is volatility per term, meaning this is just giving you the average vol for the May 20, what do I have here? May 13 term. Sigma is just the average vol for the month. So it's a VIX calculation, but it generally is the at the money vol, 3 above and 3 below. So sigma vol is just, so if you go on IB, or not IB, but Thinkorswim, do you guys see this number right here on the right side? Did you always try to figure out what this was? Okay. These are the sigma vols in Thinkorswim. This is giving you the average vol around the at the money and some in the money calls or puts. I think you need to get better. I know I gotta, I think my prescription's changing, whatever. Anyway, this screen, I have better vision on my other screen. So your volatilities would be right here. So you can compare like a shorter term option with the long, but again, you have to make sure you're kind of comparing apples to apples. So sigma vol you can do, but that will probably be for another class for next week. Basically using Thinkorswim to do this. All I mean by sigma vol is volatility per term, meaning the May 12, May 13 expiration, the May 13 expiration, what's the average vol here? Because this is trying to produce for you a synthetic or a basically an at the money vol based on all the volatilities in the strip. So today, you see VIX dying, you see 9-day driving. We should see a nice little rally into the end of the day. Why is sigma under the delta column? I don't know what the heck you're talking about, Jose. The sigma vol is right here. Right there. Everyone has a unique one. Everyone. All right, there you go. So I'll have this. This will be prepared for you to send out. I put a couple of little notes in here at the top, just as little reminders. We'll get all the notes and all the stuff of it. And there you go. So today, it looks like, it appears that we should rally into the end of the day. That's my guess. And I'm just basically calls I have in my positions, I'm just going to let drift up to the end of the day. Oh, okay. So one more time here for Toss to answer some questions. So just ignore the delta column here, just because there's your delta of your option there, Jose. This is just, this is giving you the average for the term. And then this volatility produces that standard deviation. Why would market makers allow IV to drop is Enzo's question, is because, Enzo, you're selling them options. You're selling them options. If you walked in and every order that came in was sell, 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 sell to you, what would you do? If you were trading and you're in there and you're writing tickets and every ticket's a buy ticket, do you want to pay up for it or do you want to buy it cheaper? You want to try to get it as cheap as possible. All right, it's a little past time. I know everybody's got other stuff to do today. Oh, I forgot. Hey, if you want to trade like this, learn to trade weekly profit cycles. Christian, somebody put up a link. Go buy some of our stuff so I can keep doing this. There you go. Monthly, I don't know what the offer we have is. Monthly, yearly. Stick around. All right. I think you've got Mark and Hans tomorrow. You guys have a good day. And I'm coming up with stuff for next week. All right, guys, have a good one. Andrew out.